Hey guys, so let's now take a look at the difference between cash flow and profit. Such an easy mistake to make. Please don't make it with this lesson. I'm sure you won't. Okay, so let's just have a look at each of these terms. Let's just pick up a different pen to incorporate what they mean. So firstly, take a look at profit. Right, so when it comes to profit, this includes sales revenue, okay? So this is from goods that you have sold or product services that you have actually sold. This is income directly from the sales that you have generated, and of course to actually calculate that, it is simply the price of the goods times the quantity sold there, okay? So price times quantity sold would tell you what the actual revenue is. That's the first thing that we need to know. Then we've got the cost of sales that is deducted. Now that is of course likely to be the cost of actually buying the raw materials necessary to make that final good. Then that tells us our gross profit. And then we deduct any expenses that were actually incurred in providing that service. And that finally tells us our net or our operating profit there, okay? So nice and straightforward, I hope there. Let's just take a look at cash flow. So when it comes to cash flow, we're starting here with cash inflows. Well, just imagine now that you actually get a loan. Well, a loan would be considered to be, of course, a cash inflow. So that would actually mean more money is coming into the business through that cash inflow. Would it mean you are generating more sales revenue, more price times quantity sold? Absolutely not. So that loan obviously will benefit your cash flow. You could, in addition to that, be generating some share capital through a share sale or something like that. Okay, so again, that would be a cash inflow. It would not be sales revenue though. Okay, so it just doesn't figure. Okay, so there's a variety of different things that could be injected into the business, such as owner's capital, but then you deduct those cash outflows. Now, when it comes to those cash outflows, well, you might be funding some expansion or capital expenditure, as it's known. If you're funding expansion there, that would be deducted from your overall bank balance, of course, but it is not a direct expense of actually providing existing goods and services. So it would not actually figure on your income statement and your profit and loss statement there. Okay, so that tells us cash inflows minus cash outflows tells us our net cash flow position, of course. But then we have to add on our opening balance. Now, what was in the opening balance? Well, it could have been that you actually got a loan in a previous period, or you had a share sale. So actually, your opening balance may be very buoyant from those cash injections that you've had. Again, that would not constitute profit though. And finally, we've got our closing balance there overall, okay? So net cash flow plus opening balance equals our closing balance. Hopefully that just clears up why there's a crucial difference between cash flow and profit. Profit considers the goods that are actually sold over a given period. This cash flow is day to day. Okay, thanks guys.